Welcome, everyone. My name is Itay Goldstein. I'm a professor of finance at the Wharton School at the University of Pennsylvania, chair of the finance department and director of WIFPR, Wharton Initiative on Financial Policy and Regulation. Part of our activity at WIFPR, we are commissioning white papers on policy topics of the day, relevant policy topics in finance. And this time, what we did is to organize this topic around decentralized exchanges, which is one of the hottest debates right now in finance and law. Our process is that we commission a paper, and then we hold a private roundtable around this paper, inviting experts from around the world to discuss the paper. And this is our peer review process. Then the authors of the paper revise it and submit a final version. And after that, we do this webinar for public consumption for live participants and also post it for future consumption and policy impact. So our topic, as I said, is the decentralized exchanges. And we're going to talk about the evolution of decentralized exchange, risks, benefits, and oversight. We are lucky to have three of the leading experts in the world on this topic. Cam Harvey, who is at the Wharton School of Business at Duke University. Joel Hasbrouck, who is at the Stern School of Business, NYU. And then Fahad Saleh, who is an associate professor of finance at the University of Florida. The way that we will organize it is that I will start by letting the authors give us a short presentation of what they did and what they came up with. This will take about 10 to 15 minutes, and then I will moderate a Q&A session. I will ask some of my own questions and also take some of the audience questions. So people in the audience, in case you want your questions to be held here, please use the Q&A button. And I will pick some of the questions to include in the discussion and ask the authors. So with all this in mind, let's get started. And I think, Cam, you're going to go ahead and present.
Yes. Thank you, Itay. And thank you for sponsoring this paper. Let me share my screen and go to full screen. There we go. So this is work that, as Itay said, has been peer-reviewed at the Wharton Roundtable. And let me give a basic introduction here. So what I hope to do is to maybe level the playing field a little bit, talking about some of the benefits and basic mechanics of decentralized exchange, some of the issues that arise with decentralized exchange, and of course, possible regulatory approaches. So let me start with the benefits of decentralized exchange. So this innovation is quite remarkable. This is an algorithm that allows for near immediate trading. So I'll talk about a constant product automated market maker. And this algorithm is available 24/7 with relatively constant liquidity, in contrast to the usual exchanges. Anybody can deploy a DEX. Indeed, I've deployed multiple DEX through the years. You can launch a new token immediately. So the new token can have value, can have liquidity immediately using this technique. The DEX is open source, so you can see everything. You can see the liquidity. You see the price. You see the code. It eliminates some centralization in that the traditional broker or centralized exchange is not necessary with this technology. It's interoperable in that you can buy on one DEX and sell on another in the same transaction. And again, remarkably, the DEX doesn't care if you're a buyer or a seller. It's an algorithm. You're trading against a liquidity pool. So this is different than kind of a limit order book where you are kind of matching the buyer and the seller. There's no bid-ask spread. And to run the DEX, you need to pay what's known as a gas fee in Ethereum. And most of the value of DEX trading is indeed on the Ethereum blockchain, and that's what we'll talk about today. So how does this work? So how does the algorithm work? And it turns out it's remarkably simple. And I'll give an example of a very simple constant product automated market maker. And it's one with 2 tokens. And the math is the equation x times y equals k. So k is going to be known as an invariant. So k is always constant. And x is just the number of token A. So let's say that could be Ether. And y, the number of token B. And that could be, let's say, a US dollar coin like USDC. So we start the liquidity pool with equal value of, let's say, Ether and USDC. So let me give a simple example to show you how easy this is to understand. So suppose the pool is initiated with 5 ETH and 20 USDC. Okay, so equal value of both. That implies that the price of ETH would be $4. And using this equation, 5, which is number of ETH, times 20, the number of USDC, equals 100. And 100 is the invariant. So now suppose I want to buy 1 ETH and use this DEX. So to buy 1 ETH means I need to send some USDC to the DEX and withdraw 1 ETH. And the question is, well, how much USDC do I need to send to withdraw that ETH? So the Ether in the pool right now is 5. I will draw it down to 4. But we know the 100 has to be maintained. So it's obvious that the only way to do this is for me to send 25 USDC. So the new pool will have 4 ETH and 25 USDC, and the invariant is maintained at 100. So the cost of actually buying that ETH is 5 USDC. So notice the price went up pretty dramatically from 4 to 5, and that's because this simple example is an example of a highly illiquid or very limited liquidity pool. So in practice, a pool like US dollar coin to ETH would be much larger, and the slippage would be much more minor. Okay, so let's talk about arbitrage. So most price discovery today, at least, happens on centralized exchanges. And when information arrives on the centralized exchanges, prices can jump immediately. In a DEX, the algorithm doesn't allow a jump. There's an adjustment, a gradual adjustment. So there can be arbitrage opportunities going from a centralized exchange to a decentralized exchange. And this is a disadvantage. Indeed, the liquidity providers are disadvantaged by this sniping. But to balance that, the liquidity providers are getting a fee for every trade. There's also another arbitrage, which is DEX-DEX. And I mentioned at the beginning, these DEX are interoperable. So again, you can buy on one and sell on another in the same transaction. And indeed, we can have many different DEX representing the same pair, let's say Ether and USDC. So this is another arbitrage. And again, this is a cost to the liquidity provider. Okay, so the DEX technology is constantly evolving. Early versions, for example, the Uniswap version 2, have been upgraded to version 3, where liquidity providers can provide liquidity in a particular range. And we've also got an even newer version, Uniswap X, and the yet to be released Uniswap 4. And again, I want to emphasize here that this innovation is changing through time and mostly open source. So I've talked about one of the costs, and that is the liquidity providers are subject to this sniping. I want to talk more generally about a concept called maximal extractable value. So sometimes called MEV or MEV. So arbitrage is one, but there are other types of ways to extract value, because in this system, if you're the proposer of a block of transactions, you get to order the transactions or insert transactions. So when we use the DEX, we put the order in, but the execution doesn't happen until the transaction is posted in the Ethereum blockchain. So Ethereum works now on a consensus mechanism called proof of stake. So those that want to stake their ETH to support the system as a validator get rewards for good behavior. And if there's bad behavior, there is a penalty known as a slash. So the blocks go up every 12 seconds. And there is one particular entity that is designated to propose a block of transactions. And this proposer effectively has monopoly power over the transactions that they choose, the ordering, and indeed, as I mentioned, they put their own transactions in. So it turns out that there are many sort of agents in this space, and 90% of these blocks are done by a group called builders. So they search for the most profitable transactions to put in. So when you actually put a transaction as pending, you might include a tip or a priority fee because you want that transaction executed as quickly as possible. But there's other things that could be done. Again, you've got a monopoly. You might see a pending transaction for, let's say, a large buy on a decentralized exchange, and you know the way decentralized exchanges work, that will push the price up. So it's possible for a builder to insert a transaction before that buy to front run that transaction and then to immediately sell afterwards. And this is called a sandwich attack. And it is close to risk-free profit for the builder. So the builder needs to get the proposer to actually accept what they've constructed. And there's an auction that happens every 12 seconds. And part of this gain is going to be transferred to the proposer. So this is, again, part of the MEV that's happening. Again, you can see it. I've got a link down there to payload.de/data where you can see this auction occurring in real time every 12 seconds. So there are a number of research initiatives that are looking at ways to improve the DEX, and in particular, focused on this maximal extracted value. So things like time sequencing of transactions, some sort of tax or a rebate of the MEV. So there's a lot of work actually going on here to improve the actual space. But if we really think about it, the liquidity providers are getting a fee. So if there's a lot of MEV, then you need to have liquidity in the pool. So it has to be somewhat attractive to the liquidity providers. So if we reduce the MEV, then it's possible that the fees for actually doing transactions could be reduced. So again, there's a lot of research going on here in terms of MEV mitigation. There's a lot of research looking at not just the standard layer one, like the Ethereum protocol, but so-called layer twos. There is an active agenda in restaking and many other things that are going on. Okay, so let me briefly talk about oversight. And this is, an important part of our paper. So one thing that's very difficult to deal with is certain addresses have been sanctioned. And using a DEX, you don't really, there's no KYC or anything like that. It's possible for certain builders to exclude blacklisted addresses, but this only works if all builders do this, and it's very unlikely that that would happen. It's also the case that the list of sanctioned addresses is not that frequently updated. And indeed, anybody can create a new address once their address has been sanctioned. So this is a very, very challenging issue. So part of our paper kind of asked the question, well, we can identify some kind of risks of this technology. We recognize all the advantages, but given these risks, well, what is the role for regulation? So there's many different targets for regulation. One would be to regulate the users, but the regulator actually, indeed, if you look at the history of the Securities Act in 1933, the motivation was to protect the users, to protect investors. So to go sanction users doesn't really make sense in terms of the spirit of the Securities Act. Number two, you could just ban DEX trading, but this is a global technology. So you can deploy a DEX anywhere in the world. It resides on thousands of computers around the world. So this is not just one country's problem. So a third possibility is to regulate an organization that might support some DEX. So a good example here, the leading DEX is Uniswap, and Uniswap has a lab known as Uniswap Labs. So the lab does things like fixing bugs and making the technology more secure. So to actually try to sanction the labs might make the whole space riskier. Number four, there's a possibility of indirect regulation. So it makes sense that centralized exchanges might see a better deal on a DEX for a particular transaction and want to use that DEX. So it's possible that regulators could ask or require the centralized exchanges to do due diligence on the DEX that they're actually using. And number five seems to be the way that we're heading, and that is self-mitigation. The community improving the protocol, making transactions more efficient, and potentially coming to the point where some of the MEV could be redistributed. So overall, the regulatory task is very challenging. It's a balancing act. And we all know that harsh regulations drive innovation offshore. And no country wants to lose some of their most promising innovation to another country. This technology is also complex. So time needs to be put in to understand the technology. And indeed, even after you get a reasonably good understanding of the technology, the field is moving so quickly that you need to continually invest in updating that knowledge. And finally, it's a challenge for regulators just to recruit people knowledgeable in this space, given that there's so many opportunities outside available to them. So this is kind of the basic introduction to our paper. And at this point, we'd be more than willing to open it up to questions.
Great, thank you very much, Cam. Great presentation and really interesting paper. I recommend everyone to read it. I think it provides a very clear overview of what decentralized exchanges are and how they're different from centralized exchanges and what are the challenges that we are facing. So we're going to have some discussion now. I want to remind people in the audience that if you want to ask questions, please submit them in the Q&A function, and I will monitor it and include some of the questions in my discussion with the authors. I would like to start by thinking more about what are the potential benefits of decentralized exchanges. You talk about it in the paper. You write that it provides democratization of financial markets, a system where no one is different from anyone else and everyone is a peer. And that sounds very appealing in many ways. But when you're thinking about it a little more, the question is how desirable that is. Certainly, when you think about centralization versus decentralization, there is some trade-off. And a system where no one is different and there is no central power could also have some very significant flaws. So can you think about it with us a little more? What do you think is the trade-off here? What exactly are we looking at?
I can start there, Joel.
Let me take a crack at it. This is something that we have discussed amongst the three of ourselves and other audiences. So it really does get to the heart of it, because we can think of many aspects of financial markets where we might assume all agents are identical, and in that situation, decentralization is sort of a logical way to structure a market. In other respects, though, participants are not identical. Currently in the US equities market, we're debating what to do or how to handle retail traders. And although we often think that the institutions sort of have it in for the little guy and manage to extract better deals, retail trading costs in the equities markets are very low. So if we can't allow, if there's no way for a retail trader to certify that they're retail, their cost of trading will go up. And that's just one example, sort of reinforces Cam's point that we're going to need some kind of balance here that allows for just the sort of Goldilocks solution for centralization and decentralization.
Yeah, let me add to that. And thank you, Joel. The way that I look at it is that we will have centralized exchange for quite a while. That we've seen significant growth in decentralized exchange, and I think we'll continue to see that growth. And maybe at some point when all assets are tokenized, that we will have just decentralized exchange, but I think we're like pretty far from that. So this is, think of decentralized exchange as solving some problems that exist with centralized exchanges. But as Joel said, there's trade-offs. So there's no customer service line that you can call. That right now, to actually trade on decentralized exchange requires some level of sophistication in terms of setting up a wallet and things like that. So I do think that at this point, it's not for everybody. It is kind of clunky at this point. And let me just underline my words, at this point, because it's constantly improving. So there are trade-offs, explicit trade-offs, and this is material that we definitely deal with in the paper, but this is a technology that's not for everybody at this point. And that's important to recognize.
So if I can just add a little bit here, I think the core trade-off actually goes to kind of the heart of our paper, which is in some sense it's access and cost versus investor protection, right? So if nobody is allowed to access a platform, then nobody can be defrauded. But if everybody's allowed to access it, then you have to start worrying about the potential for people who don't know what they're doing, engaging with the platform and then being defrauded, right? This is sort of the whole reason why we're thinking about regulation in this context, which is that there's a concern that there are investors involved here who are getting bad outcomes and maybe don't know how to sort of deal with that themselves. The cost side, which I also mentioned here, is related, of course, to this in the sense that decentralized exchanges in principle don't have any overhead costs, right? They're computer programs on a blockchain. But the more you regulate, the more you think about investor protection and sort of taking a little bit away from the access, the more costs you're going to have, right? Regulation entails costs, and so it's directly tied to this access versus investor protection trade-off.
Yeah. So talking about regulation, this is one of the areas of focus of your paper, talking about the challenges of regulation, how they're different from traditional financial systems, and you propose a few solutions. I was wondering if you can go a little more into that and tell us, if you were regulators right now, what you would do. And I will use this opportunity to link to one of the questions that we got here in the Q&A that is asking about something more specific. Given the difficulties with traditional regulation, is there a way to code the regulatory rules so they operate on the blockchain? So what are your thoughts about that specific angle, and more generally, what would you propose?
So I can start us off on this one if Cam and Joel don't mind. I want to avoid offering a specific precise regulation because we have to be dynamic in response to things that are going on. But the one thing that I really think is worth highlighting here is that the crypto community itself is incredibly inventive and incredibly aware of these problems. And I think regulators are not sufficiently aware of the conversations happening in crypto communities to deal with these problems. And I also think they're not sufficiently aware of the sort of research that has gone into studying some of those problems. So if you're really pushing to sort of get a prescription, though, I would lean a little bit more towards the side of letting the crypto community figure things out. That doesn't mean we don't need some of the sort of, let's call it, traditional regulation over top of that. But at a minimum right now, I think regulators are entirely too unaware of what's actually going on the ground, and also entirely too unaware of the research by professors at top schools and so on that is studying those sorts of things and showing progress in some of the ideas in the space.
If I can continue, go on, Cam.
Yeah, no, I just to emphasize Fahad's point, it was really disappointing when Uniswap Labs got served a Wells notice. And it just smacked to me of the regulator not really understanding this particular space and the positive influence that Uniswap Labs has had. I also want to emphasize what Fahad said, that if you look at the sort of research that's going on in this space, it is coming up with ideas to address these downsides. So within a year or so, the list of problems is going to look different and it's going to be much smaller. So I think that given the positive momentum that's going on in terms of research, that it would be great for the regulator to actually take a look at that momentum before pulling the trigger on punitive measures that just set us back.
I don't want to bash the regulators entirely here, because self-regulation and delegated industry regulation has long been a part of our securities markets. So, for example, we have the stock exchanges. They're assigned the responsibility of monitoring and enforcing their own rules. We have FINRA. So delegating certain regulation to the industry is it's part of our tradition, because from the beginning it's been recognized that that's where the expertise and, frankly, the long-term interest of good regulation lies. The challenges that I think regulators face is that as economists, we idealize functional regulation. That is, if somebody does a certain thing and there's others that do a similar thing, we regulate them as a group. But most regulation is institutional. And if I were a regulator, I might think that it's almost trying to grasp smoke, because the institutions here are changing so quickly. That is a good thing, as Cam has pointed out. It indicates a very lively innovation. It also means, and as a regulator, you're worried that you'd like to be able to knock on the door of the market, and maybe you're there because you just want to see, hey, what are you doing? Or maybe you're there because you suspect something, but it's not yet clear to any of us, I think, what the enduring institutions are going to be.
Yeah, that's an excellent point. Just let me add a little bit to it. And this is like a different sort of landscape compared to anything else that we've ever dealt with in a regulatory environment. Indeed, usually, and most of the regulatory actions have been focused on centralized institutions. So these are centralized exchanges, for example, or lenders, that there's a phone number, there's a CEO, there's a board of directors, there's a physical location. These are algorithms, and the identical algorithm is deployed on thousands of computers around the world. So who do you serve? So it's very, very challenging in this global context. But Joel makes like an important point that there is a role for regulation. And you might argue that some of the improvements that are being proposed in research right now to mitigate some of these risks are a result of uncertainty over what regulation might look like in the US. So there is an incentive to do certain things that might reduce the chance of a sort of regulatory environment that kind of sets this space back. I do think that it's also the case in this kind of battle between decentralized exchange and centralized exchange that much of the motivation is to make the prices that are obtained by buyers and sellers the most efficient with the lowest trading costs as possible. So I do think that these improvements are both to have the most efficient mechanism for transaction, as well as reduce the regulatory risk.
Yeah, so one of the issues here, and you talk about it in the paper, is the international coordination and the fact that, we always care about international coordination, but this might be a more severe issue here in the context of crypto and decentralized exchanges. I wonder what you think about that, and I also want to connect it to a question we got from the audience, which is about the approach taken by US versus non-US regulators. And I think the general sense that maybe non-US regulators are a bit more constructive and get this space a little better than US regulators.
Yeah, so that question I actually just looked at, and they noted what the, for example, the JFSF or JFSA in Japan prevented Japan being exposed to FTX. And I think that's exactly the point I was making. FTX was a centralized exchange. There was a CEO. They did have a location, and it's reasonably straightforward to regulate even an offshore centralized exchange within the boundary of your country. This is different. This is anybody can deploy a DEX. And it's just really hard to think about this. And there's obviously evolving regulatory environments. So Europe has got MiCA right now. The US is working towards some sort of framework, but MiCA says very little about decentralized finance. It's overwhelmingly focused on centralized crypto. So things like centralized exchanges. And I think given the lack of attention paid to decentralized finance in MiCA in the EU is just emphasizing this point that it's extremely difficult to think about how to approach regulating an algorithm.
So if I can add to that, I want to make 2 points. One, I want to reemphasize what Cam said there about the fact that sort of the regulations being referenced in the chat are, FTX was a centralized exchange. And so the context is very different. And so, for instance, when I was earlier talking about my feeling that regulators don't understand enough about the crypto community, I wasn't talking about centralized exchanges, right? I was talking about the fact that, for example, the Ethereum community has a whole bunch of ideas like execution tickets and execution options. And now Uniswap v4 is all about this idea of hooks, where certain players are thinking about using that functionality to essentially capture MEV and pay it back to traders. I'm talking about those sorts of things. Like this is decentralized finance, right? I don't think regulating a centralized exchange that happens to trade crypto assets is sort of a materially novel thing. And I don't think a regulator in principle should have that much difficulty getting up to speed on that. My concern is that they seem completely oblivious to the sort of DeFi conversation and their understanding of these sorts of things, these economic designs that are being proposed in the crypto community, whether it's around Ethereum or around decentralized applications like Uniswap v4. I don't think they have a proper understanding of it, and I think that's true across jurisdictions. Whether or not there are certain jurisdictions that are being more constructive, generally speaking, I don't think those jurisdictions though have a proper understanding of this. And let me dovetail that with the second point I want to make, which is, one reaction when it comes to like who should we regulate and so on is to say, okay, fine. So technically speaking, Uniswap, let's say v3, which is the latest version deployed now, is just a computer program on a blockchain. But as we're being discussed, there is this thing called Uniswap Labs, and there is this thing called Uniswap Foundation. And similarly, if you start thinking about like builders that Cam was referencing, it's a very consolidated market. If you really wanted to go and like touch somebody who's affecting this space, you probably could, because for the moment they're not that inaccessible, right? But I think that would be a bad approach for regulators to take, which I think is related to like Cam's point about the Wells notice to Uniswap Labs. Yes, you can, for the moment, go after certain entities that are related to certain computer programs on a blockchain or certain builders or whatever. But if you want to push that point, then you're going to get into a bit of a fight where they're going to not be so easy to access, right? Like there's an endogenous effect to serving Wells notices to people, right? And I don't know whether the legal community wants to get in a fight with the tech community, because the tech community the crypto community is sort of a part of that, has a lot of intellectual capital, and they're not using it right now to evade regulation. So I don't think it's a good idea to encourage people who are very smart to find ways to evade regulation.
Okay, so we have just a few minutes left. I think I will try to close it with some reflection on what decentralized exchanges did over the last few years and projection on what they might do in the future. I think one common view is that so far they haven't lived up to the expectation. I think years ago people were talking about this is going to completely change the financial system. And skeptics look at this and say, well, nothing really happened. You have all these exchanges where people trade one crypto asset against another crypto asset, but it hasn't really penetrated into the traditional financial system, traditional assets, and it's still kind of in the periphery. That's one view. You may agree or disagree with that. The question is, what do you think about that? If it is true, do you think this is mostly a problem of misguided regulation, or maybe there are some boundaries to the technology and the potential of the technology? And if you were to project forward and think about what's going to come in the next few years, where do you see it all going in the next 5 years or so?
So let me start on it. So decentralized exchange has come from like zero in a very short time to trading $3 trillion worth of assets. So it is a remarkable growth. And for somebody to assert that this is somehow disappointing, maybe that's based upon unrealistic expectations that once you introduce this new technology, then it would completely subsume all of centralized exchange. That's certainly not the way I looked at it. This is an alternative, and it takes a while in terms of building liquidity. And I think that it is on the track that I expected a number of years ago. And it does have a very positive vector for the future. So if we think about this technology in general, what I see happening is that there'll be just more general deployment of it. Think of this advantage of 24/7 trading with relatively constant liquidity. There's many assets out there that could be tokenized, and those assets could be traded much more efficiently than they're traded today on a type of decentralized exchange. Indeed, we will see, I predict, centralized entities using the AMM, the automated market maker algorithm, to solve this problem in the short term. So that would be interesting. And then more generally in the future, we talk about tokenizing of real-world assets. And currently what that is you take an asset like a stock and vault it and issue a token based upon it. And that token can be traded on a centralized exchange or a decentralized exchange. But that's just intermediary step. So eventually securities will be issued on a blockchain. So when those securities are issued on a blockchain, then they're instantly tokenized. And I see that is a very important kind of tipping point where we'll see much more activity on decentralized exchanges. So I think that given all of the benefits that exist here in terms of reducing the cost of trading, having this fundamental democracy where it doesn't matter who you are when you're interacting with the decentralized exchange, cutting out some of the costs, reducing the time from trade to the actual settlement of a trade. which is currently like 1 day. We just moved from 2 days to 1 day to something much shorter, like within the range of half a minute. You put all of this stuff together, there's so many positives to this. But again, in our paper, we recognize that there are some negatives. And the point that we're making in the paper that these negatives are an active area of research. So I think that we're seeing essentially the beginning of an innovation. And the path forward, I think, is quite promising.
If I can just, sorry, go ahead.
Maybe just half a minute.
Okay, so one thing I want to reemphasize the point about, I think people don't realize how much has been done and how quickly it's been done. In the framing, you mentioned 10 years. 10 years ago, decentralized exchanges didn't exist, right? So the framing just for decentralized exchanges themselves is we're talking about the last 5 years. When if you'd ask people 5 years ago, I think amongst finance professors about even having swaps, asset swaps done through a blockchain, they'd say that's insane because how is this going to incorporate information? And they figured it out, much to the surprise of, I think, the academic community. And we've had a lot of evolution since then. So I would disagree with the framing of this being disappointing. I think people don't realize how much has been done and the timeline on which it has been done. Quickly on the point about sort of getting to the mainstream, that's actually, I think, a political economy thing. So the crypto community, by and large, I think, has not paid as much attention to trying to make things accessible for mainstream for mainstream communities, and they've sort of paid more attention to sort of making it more fun for themselves. One of the reasons for that, though, is also related to the fact that they don't see a lot of regulatory certainty and are sometimes thinking about playing sort of, let's call it a timing game associated when there are regulators that are more sort of let's say aware of things, right? So in some cases they're purposefully sort of waiting. I don't know how that's going to manifest, but again, I don't think the community is really spending a lot of time going, how do I make people who are completely unfamiliar with technology use crypto? And so I think they've actually been very successful in what they've been doing and what they've been targeting.
Thank you. Joel, did you want to add anything before we?
We're past your time limit, so I don't want to. Anybody who wants further discussion, they have our email addresses.
Yes. Okay. Thank you very much. This was really insightful and certainly inspiring thoughts at the very end. I think encouraging all of us to look more into it and explore it. The paper is available on our website and will be distributed more broadly. I think this really opens the door to a lot of research on crypto and decentralized exchanges. So thank you again.
Thank you, Itay.
Thank you.
Thank you, Itay.